Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, good afternoon. This is Tuesday Tech Talk with David Blake, and today we're going to quickly review the last couple of days, figure out what the market wants to do, and after that we'll look at some of the different indexes, determine support and resistance areas. Then we're going to go over the CTI and how we can go from a sell to a neutral position, as we were going to do last week. I want to show you some of the other indicators that we look at that can kind of delay or cut short the different market posture calls. Okay, after that, we'll open it up to some questions. I usually talk about 20-25 minutes, and you can ask us about individual stocks. And we had a couple of questions came in earlier that I'll touch base on. But like I mentioned earlier, we had a lot of questions last week and over the weekend about how the market posture remained neutral, and we're going to go over the other components of the market posture besides the CTI. And we'll look at the momentum index, the sentiment index, and also some of the market breadth indicators that we look at that can weigh on what we're going to do. Okay, last Tuesday when we were talking, we were getting ready to flip the CTI and the market posture to bearish. We were showing negative divergence in some of the different indicators on some of the different charts. The MACD short term, that's a 12.26.9, had had given a bearish signal on most of the indicators, and shortly after we wrapped up the meeting, Fed Chairman Janet Yellen came in and kind of went against what some of the other Fed chiefs governors were talking about the previous week, that they were getting more hawkish on rates, and she kind of put the market at ease in saying that they were going to be very, very gradual in raising rates, and of course the market took off triple digits, and actually, that took away most of the negative divergence that we were looking at, and it gave a boost that lasted a day or two, which it normally does when the Fed props up the market, and that caused some of the secondary indicators that we look at in indexes to move back to a little bit more of a neutral to positive position, and that's why we extended out the market posture to a second week of being neutral. Of course, this week it looks like we're down about 150 so far this week, so maybe we should have flipped. But I just want to touch base on why we were a little bit more conservative. Okay, so last week also we got a positive ISM manufacturing index number on Friday. That showed expansion for the first time in the manufacturing area for the first time in several months. That gave another rally up to stocks on Friday after they were initially lower at the open. And then, and that was also despite a 4% slide in crude oil on Friday, which was interesting. The rally that we've had in crude oil looks like it's kind of topped out. You know, a lot of that was caused by the short covering rally. I don't think there was a lot of new buying going on in that thing. Now we've seen oil come down the last couple of days. It was down 3% earlier today. So we're getting a little bit of the market back in lockstep with that. What they're doing is they're basically backing off the inclination that OPEC and Saudi Arabia is going to cut oil production if the Iranians cut production, and it doesn't look like the Iranians want to cut production. As to them, $30 is better than nothing. So they're going to probably keep pumping as much as they can. So I don't think you're going to see oil go down maybe to the $26 level again anytime soon. But we want to watch that probably 32 to 34 area would probably be a bottom. That's where we can see support, which was the resistance on the way up. Once it cracked through 34, it made that run up to about 38 and then to the low 40s. So today, like I say, the global markets are all down, especially Europe. Europe's down about 2%. Especially European banks are down on some weaker economic data. European banks are down 5 to 6%, especially in Italy. So maybe something's going on over there that's going to with the pig nations again. So we'll kind of watch that and take things from there. Okay, first thing I want to do, like we normally do, is kind of look at the charts where we're going to find support, resistance, and all. Again, the first thing we have here, again, that we showed you the last couple of weeks, this is that chart that shows you how the market has performed on the 8th year of a presidential cycle. Doesn't look good. We're right over here right now, and I think that we'll probably be in this period here going out over the next few weeks. So that adds a little bit of credence to what we're doing with the CTI. Okay, first we have the Dow Jones. The good news is that we broke above the descending trend line off the highs from last year. But over here you can see a little bit of negative divergence starting to show up now on the Dow Jones, which hadn't been there for the last several weeks. That's for us, if we're looking for a down market, we want to see that. We also see the MACD starting to roll over on the Dow also. Now the 200-day moving average is down here around 17,120, 17,125. That also represents what was 61.8% of the Fibonacci retracement from this move, from down here in November down to the January, February low. So that's an area that's probably going to provide a short-term relief, 17.2 right at that area. Also, the pivot point for the Dow Jones, which we don't have on the chart, but we're going to be adding those at some point going forward, is around 17,340, which is just below the 21-day moving average. The pivot point, if it trades below 17,340, that would end the positive bias on the Dow Jones, and at that point you would begin to think that the downside could start to pick up a little bit of speed. Okay, the next one we're going to look at real quick is the S&P 500. It hasn't quite made it up to the descending trend line, but we're starting to see some choppy action up here. The 200-day moving average is down here around 2020. Today we're down, let's see, right now we're at about 2050. I think around 2040, if it breaks this, which is last week's low, you'll start to see selling intensify a little bit. But around that 2020 area, if it breaks through that, that's the 200-day moving average and also the 61.8% Fibonacci retracement. And also the pivot point on the S&P 500 is 2023. So that would be the area where this battle could start to get a little bit ugly and pick up to the downside. And the support levels, the first support level after it breaks that pivot point is down here around 1970 or so, which represents around the 100-day moving average. Okay, the NASDAQ, we finally broke the 200-day moving average on the upside. We're not even close to the descending trend line yet. Today we are at 48.58, which is right at the 200-day. The 200-day is 48.60, so we're sitting on this right here, which also represents, again, the 61.8% retracement of this move down. So we want to watch that. It's going to struggle right in here. Break below that, we'll probably see a test of first of the 100-day moving average down here around just below 4,800. The pivot point on the NASDAQ is 47.81, which is right at the 100-day moving average. So that's where the battle to see if we're going to have a real shot down here the next couple of weeks is going to be fought. That's what you want to watch. We are seeing the negative divergence again on the RSI 14-day, also on the MACD short-term. We're getting some sell action on that probably today too. Okay, the Russell 2000, which you would want to see leading the market if things were picking up, especially business-wise. Okay, it's stalled over here at the 61.8% retracement of this move down. We didn't make it up to the 200-day, which also coincides with the descending trend line. If for some reason we get another boost by a Fed chairman saying they'll never cut rates or something, you might see it come up to here. But right now we've stalled at this level, and I think you'll probably see it pull back down here around the 1080 level. That would be where the big battle kind of goes on. That's the 100-day. That's where we had a little bit of building up around here, right around 1075, 1080. The pivot point on the Russell 2000 is 1087. If it breaks below that, that'll give us more of a bearish look to the whole chart. We'll also see a lot of negative divergence on the RSI 14-day on the Russell 2000. This is getting real toppy on this. And the MACD also went to a sell, then back to a buy after last week's Fed-induced rally, and now we're going back to a sell on that. And the other index we want to look at real briefly is the Dow Jones Transportation Index, which we talk a lot about this as being one of the keys to what's going to happen. Okay, it rallied right up to the descending trend line, rolled over, came down here, tested the 200-day, came back up, bounced off the trend line again. Now we're over here. We actually have, it's a 77.90. We're trading just below the 200-day moving average, which is right above, again, just above that 61.8% retracement. So we're going to have a little bit of a battle here. It rolls over. You'll see the, let me say, the pivot point on that is 78.16, which is also right way at. So we have a lot going on with the Dow Jones Transportation Index. If you see this thing come down and take out this, say 77.50 or something like that, that's going to give you a kind of a forewarning that the market's probably headed lower, and that'll be the end of this rally. And we'll be in the right, hopefully positioned rightly, thinking the market's going to go bearish. Okay, so to wrap that up, again, we're right where we were last Tuesday, where it looks like things are getting close to starting to break down a little bit. The negative divergences that we saw before are showing back up, and it looks like we probably have a short-term top. Some of the other indicators are looking bearish. Volume has shrunk considerably over the last couple of weeks. Not that there's a lot of selling going on, but I just don't see a lot of new buying coming into the market. And also with these some of the different momentum indicators we're seeing with our momentum index and some of the other momentum index technical indicators, we're also seeing some deterioration there. Okay, so now let's get to the market posture, the CTI. Okay, what the CTI is trying to do, if you're not real familiar with it and you haven't heard the last couple of weeks, it's trying to identify periods in the market that historically have shown kind of weak results or periods where the bias becomes bearish. It has to do a little bit with the business cycle, but also other periods as far as seasonal periods, other things that we look at. And if we measure them all together, we put a number on each cycle as far as where it is in its number of weeks, and then we can come out with a CTI projection over that. Because there seems to be a flow in the market and business cycles, and we can lighten up during these periods of weakness, and you're maybe on the sidelines, you're hedging yourself, and you're avoiding these 15% pullbacks or 20% pullbacks or more. Is greatly going to return your returns in the market. Okay, this next slide is what we're looking at the CTI projections. At the end of this week, we'll also be at -2, which isn't real weak, but it shows you after starting going into next week, we go to a -8 for 3 weeks, then we go to a -10 for 3 weeks, and according to that, at the end of May, we should probably be bottoming out somewhere around that. The old sell in May and go away. This year is probably going to be another good excuse for that. We actually go to a buy for about 5 or 6 weeks in the summer, which you can follow in the weekly market letter that comes out on Friday. We'll put some more of our projections going for that. But starting in June, it looks like we have a sideways to maybe a little bit higher, and then we go to another projected to go to a sell again sometime in August. But this will show you that the CTI, and as long as you see in the market letter and some of the stuff where we start seeing the momentum index get even worse, where right now we're at a 1 or a 2, where you start to see the momentum index go to a -4, -5 or something like that, that just means that the odds of the market going down more than just 7 or 8 or 9% is going to increase. Okay, now here's some of the other components of what we look at in the market posture. This is from Friday's market letter, and the first thing that you want to look at up here is the momentum index. It was unchanged last week. It actually was a little bit higher. It came off, moved down a notch. But what this measures is number one, it's going to measure whether or not the other individual indexes are outperforming or underperforming the Dow Jones. Okay, if the other indexes are outperforming that Dow Jones on the way up, the momentum index could go to 4, 5, 6, or 7, even 10. If on the way down, like what we're looking at right now, if the other indexes like the Russell and the Dow Jones transports and stuff go down quicker or more percentage-wise than the Dow Jones, then you're going to see the momentum index go to a -3, -4. And with our call, unless something happens, going to a sell in the market on Friday, what you want to look for in the momentum index is to see this thing maybe go to -2 this Friday. and maybe next week we'll start seeing it go down to -4, something like that. And that means that the market posture is correct, and you're going to and the selling will probably intensify a little bit at that point. But other things that we look at in here, we also look at new highs and new lows. This was something that was a red flag for us last fall when we were bullish on the market, and we went to I think we went to sell sometime in the 1st of December, something like that. But what we were seeing, we were looking at the market making a run towards the old highs, and what we were getting 120 to 100, maybe 190 new highs. At the same time, we were recording 270 to 600 new lows. That showed us, especially in the NASDAQ 100, how thin the actual rally was, and it wasn't a broad participation. So we want to always watch that when we're watching the moves up and down. As of last week, I think we had like 150 new highs, but we still had like 120 new lows. So it's still an even. That's kind of a neutral call on that. So that is something we also want to look at. Okay, the next thing that comes into play is the sentiment index. Again, the sentiment is neutral currently, but just 2 weeks ago it was negative, which in our case, when the sentiment is negative, that means everybody is too negative, which is bullish for the market. So it's kind of a contrarian indicator. Okay, so the stocks were rising here all through March, and sentiment was horrible. It was up around 3 or 4. Everybody thought that we were going into a recession at any time. And somehow the last 2 weeks after the market got up here to the highs and we're starting to roll over, all of a sudden everybody's looking at has gotten bullish on the market at this point. So that's a little bit of a red flag there. But we look at the short interest in the market. We look at the CNN's Fear and Greed Index. It's currently neutral, but I think yesterday it was 74, so above 75 gives us a little bit of alarm. So we're getting up there where we want to see that, we're at the top of the range on that. We also look at the bullish and bearish investment advisors. We're neutral right now. We were bullish on the bullish investment advisors, and we had too many that were bearish, in other words. And the reason why that's important is when everybody is bullish, it means they're already fully invested in the market, and they don't have a lot of funds to be driving the market higher. So when you see the bullish investment advisors get up, around 50 or 55, then you know that we're getting close to a top at that point. But again, those usually work best at extremes. We've talked about that with some of these indicators, and that's also one. We also had the VIX falling all the way down to 1310. We haven't seen that. That was at the close, I think, of last Friday or yesterday, and we hadn't seen it that low since last August, right before the market pulled back the first time there. Today we have a nice little spike on that. It's up about 10%. The VIX currently is at 1556, so we had a nice move in that. But you want to look, you want to be cautious on that. It means that traders are getting a little bit more nervous about the sell-off. Okay, the next one we look at with go along with the CTI is the market breadth. We want to see what what the internals are telling us. And right now, as far as an NYSE AD line, this is actually a leading indicator. It looks good still. I'd like to see this thing get a little bit toppy, but people are kind of buying the big cap blue chips, especially the ones that pay a good dividend, and that's why you see this coming up close to all-time highs. If you compare that to the NASDAQ AD line, you can see over the last couple of weeks, they're buying the FANG stocks again. You've had a lot of sell-off in the biotechs again. You're not seeing a wide participation or a broad market participation in the NASDAQ AD line. This actually, to me, looks a little bit toppy, especially if we come down here about 2 days and break below these lows or this little level here. That would be another red flag for us that the market could be in a little bit of trouble. Okay, over here we can look at this, and these charts you can find on the home page on Market at a Glance. For the New York, again, you are starting to see some expansion in the new highs versus new lows. But when you look at this, you also want to look at extremes. This was the sell-off last August. Here we were the sell-off in January. Here was the last sell-off. Now, when you see something like this is actually positive divergence. Although you're making a heck of a lot more new lows, we were making the new lows in February, we were around 600 new lows. We're back in January when it rolled over at the first of the year, we were up here almost close to 1,400 new lows. So this was a little bit of positive divergence, which was one of the reasons why when we flipped to a buy, it weighed into the decision that we're having a low testing the same number on the downside, but the number of new lows making down there is positive divergence. Okay, and here was the NASDAQ. Again, you saw the positive divergence in February, where you didn't have the same amount of companies, stocks making new lows there. So again, this isn't quite as good as New York, but you are for the first time in a long way since last summer, where you're starting to get some more new highs, but not enough to look at it as a trend. Okay, just to wrap this thing up again. The CTI, we're trying to get periods where the market could be strong or weak. We want to avoid the weak periods. Help you to try to find periods where, especially if we see a crack, we're aware that this could be a weak area. We're ready for it. We may be hedging our portfolios, something like that. But as a CTI, in the whole market edge site, we try to preach that no indicator is a standalone indicator. You want to have confirmation from other parts of other indicators and other things that we look at, other indexes and that kind of thing. So if we get confirmation from the momentum, sentiment, and internal breadth, then we're going to flip the thing. And as it looks right now, it would take a lot for this thing not to flip over on Friday. Some of the questions that I had about when we flip it, some people said, okay, well, second opinion has a buy, and the leveraged ETFs have an avoid. Okay, well, this is a forward-looking indicator, and we're a forecasting model where the second opinion is a rear view model. It's looking backwards. But you also want to look at the support and resistance areas on the second opinion report for the SPY and the diamonds and the QQQ to see where areas where the market should find support, and if it breaks there, then you know that then you'll start to see that thing rolling over with the score going to -3, -4, that type of thing. So you want to look at that. But for our leverage trades against the market, we just to be conservative, we actually closed out the positions 2 Fridays ago when we went to the neutral call. This was when we were the short side, and this is when we opened them again at the end of January. And then we closed them on March 24th. Again, we were picking up anywhere from 11 to 21% on this call. We might have made a little bit more, but right now I think what the market as it is right now, we're only about 100 points or less than that. We're about 50 points from where we closed it out. So today and yesterday's action is getting us back in where we can probably get a decent move to that. So at this point, the market posture should go negative this Friday. You're going to have to see this market go up 200 points or something, 250 points before we would not flip it. So the posture will be bearish as of that. Some people also said, do I buy these leverage or shorts or just if you don't have to go the leverage, by the way, either. You can just buy a 1-for-1 long and short ETF. But they said, should I buy them on Friday near the close or wait until Monday? Just to have a disciplined approach, we always kind of buy and sell at the close on Friday. That works in our favor sometimes, sometimes not. Because anything can happen over a weekend, so it's up to you. Something can happen and the market could spike 200 points on Monday, or it could be down 200 points. So it's always a roll of the dice. That depends on your on what you feel about the market and also your risk tolerance. So obviously, if you're buying triple leveraged ETFs to play these moves, you maybe want to be a little bit more conservative and wait till Monday to see what you can get the price at, and hope that you don't have a big big drop or a big spike. So with that, we're going to wrap it up. I think we have a couple more questions. I actually had one come in earlier. We had David from New Zealand wanted to know about gold. As far as gold goes right now, you've had some weakness over the last week or two. Part of that is just because the market was better and you saw the dollar getting stronger. That was actually the dollar was getting weaker, but But the gold, once the market was moving up, gold isn't when everybody's bullish, that gold's not going to be a great investment. But if we're correct here and the market does roll over, I think you'll see the gold mining and gold stocks come back up here. I think longer term they're going to be fine. So I still would think this may be an area where you may want to actually pull into positions. Okay, or add the positions on gold. Let me close this here so we can share the screen and look at some of the charts. Okay, can you see that? Okay. All right, so let's look at get to these questions here. We have okay, like SPXU. Is there one for the Russell 2000? Yes, there is. It's SRTY. Is the short is a triple leverage short for the Russell 2000? At what point would you be a buyer of gold? Okay, I think you're at a level right here where you could be nibbling away at gold. If the market begins to roll over again, gold will take off pretty quick again. So I think you can add the positions. The only way that if the market goes sideways to here, and then for the next month or so, at that point maybe you lighten up, going out another 6 weeks or so. But at this point, I think you can still keep a little bit of money in gold as long as the market stays weak. Okay, can't see the chart. Are you sharing the chart, David? Not sure. Not sure about that. But here's the chart on that. Here's gold. If you want to take a look at this, something we look at. This is going back about 3 years. As you can see, the swings in this. We kept having lower lows and lower highs, and this trend line was that we finally broke. It's like this is called a fake breakout down here, and then we had the big rally here this first quarter, which is one of the strongest rallies in gold since 1930 or something like that. But we broke this descending trend line. We've come back now and tested it. That's why I think you're at a pretty good position to add the positions, because you're here from this low to this recent high. We've covered down here. We've retraced about a third of that move back down. That's also where this descending trend line is coming into play. So you have a lot of stuff going on. That's also the 50-day moving average, all convening right here at where we are right now. So I think this is a place where you can nibble away. The 30-day stochastic, which I like, is oversold at this level, and I think the momentum indicator is also starting to tick up a little bit on that, and the MACD histogram you can see rising over here too. So I think this is a pretty fairly low risk at this level, and of course if the market would turn around and take off again, and we get down in here, you'd probably want to clear that out. But at this point, I think you can nibble away and take some of that. Okay, any more? We have about 30 minutes. We've already gone. Does anyone have any more questions on this about the CTI or maybe some individual stocks? I don't see anybody typing. So again, there's probably a 90% chance that we'll be flipping to a negative or bearish market stance on Friday. The only reason we're going to see something, oops, got another one coming in here. Does silver follow gold? Yeah, it does a lot of times. I haven't been following silver myself because I've been looking at the gold charts. I don't have the silver up right now, but it usually will. And there's actually some time periods when silver can outperform gold. But I will look at that for next week, or if you want to send me an email, I'll try to get something back to you. Just do the doc at marketedge.com, and I'll take a look at the chart and send that back to you. Okay, I assume the CTI projection is for the A cycle. I meant to put a chart up on this, and I did, or a slide. Okay, right now we're in. What multiples do you use on these cycles? Okay, I'll go into that in just 1 second. Right now we're in week 5. A, C, and E are all bearish. B and D are bullish. We are in week 5 for cycle A, week 11 for cycle B, Cycle C and D are both at 32, and Cycle E is in week 177. And I will tell you that that week at the week ending 6/3, A, B, and C will all bottom at the same time. So I would expect at that point we'll probably see sideways up market in June. We could have a little bit of a bounce, and then the Cycle E, which would start a new bull market, would probably bottom sometime at the end of the year. Okay, the multiples that we use, Cycle A is about 6 weeks. Cycle B is about 18. Cycle C is 36. D is 72, and E is 215. Somebody else has another question here. Okay, even though we're now in negative CTI, are there any sectors that look good over the next few weeks on the long side? Well, you got the utilities that are making an all-time high. It's a defensive sector, but they're getting expensive. Even the consumer staples, which is outperformed. Generally, the consumer staples sector will trade at around 13, 14 times earnings. It's up here around 21 times earnings. So that's on stocks like the Procter and Gamble's and Colgate and stuff like that. To me, that's just too much risk in trying to buy, go long at this stage. I think to me, what I try to do on the negative market posture is either leverage myself. I don't buy anything new. I'll wait on the sidelines and I'll keep that money. And if I'm wanting to buy something right now, I think you just stay on the sidelines and wait for about 6-7 weeks, and if the market bottoms out at that point, then you got a lot of cash on the sidelines or in your account, and you're ready to go. Okay, that's about it. I don't see any more questions coming in, so I'm going to go ahead and wrap it up. Again, if you have any questions, you can email me at the doc@marketedge.com, and I'll get to you, either today or tomorrow. We'll flip to bearish on Friday. You can play it any way you want to, even buying puts on positions you might have some good gains on. Other than that, we'll see you next week. Thanks for joining me, and we'll talk to you then.